Today, we are delving into the numbers behind the real estate market, specifically focusing on the increasing inventory of homes available for sale. Now, whether you're a prospective buyer or seller, understanding these trends are crucial for making informed decisions in today's housing landscape. Hi, it's Brooks and Christopher Marr with MMG Real Estate Advisors here with our March of 2024 Orange County Real Estate Market Report. If you find the information in this video helpful, be sure to hit that like button. If you want to see more, hit that subscribe so you never miss out. Now, let's start by dissecting the statistics. For the beginning of the year until now, there has been a noticeable uptick in the number of homes hitting the market. In Orange County alone, the active inventory has risen by 17%, with 299 more homes available for purchase compared to the start of the year. But what does this mean for buyers and sellers? To put things into perspective, let's take a broader look at the past few years. Before the COVID-19 pandemic disrupted the market, the housing scene was more stable, with mortgage rates hovering in the low to mid 4% range. During this period, the active inventory would typically follow a cyclical pattern, gradually increasing during the winter market, peaking in the summer market, and then tapering off. However, in recent years, we've seen deviations from this norm. For instance, in 2022, the inventory experienced a significant surge, rising by 41% amidst soaring mortgage rates. Now in 2024, while the inventory has grown, it's important to note that it still falls significantly short of pre-pandemic levels. The 2,084 homes available today might seem like progress compared to previous years, but it's still a staggering 61% lower than the 3-year average before COVID, indicating an ongoing inventory crisis. For sellers, the increase in inventory presents both opportunities and challenges. On one hand, the market remains hot, with negotiations often favoring sellers. However, a growing inventory suggests that sellers may be overestimating the value of their properties, leading to prolonged listing periods and potential price reductions. In fact, 22% of homes currently on the market have already adjusted their prices downwards at least once. As for buyers, the growing inventory offers a glimmer of hope in what has been a fiercely competitive market. More options mean less pressure to settle for a property that may not fully meet their needs. Additionally, the rise in inventory could exert downward pressure on prices, providing buyers with increased bargaining power, particularly in the face of higher mortgage rates. Now, while the uptick in home inventory signals a positive trend in the housing market, the crisis is far from over. Sellers must remain vigilant in pricing their properties appropriately to attract buyers, while buyers should leverage the increased options and potential price adjustments to find their dream home at a reasonable cost. Now, let me give you the hard numbers. Active listings. In the past couple of weeks, Orange County's active listing inventory has seen a notable increase, rising by 92 homes, marking a 5% uptick. The current active listing inventory now sits at 2,084 properties, and as we transition into the spring housing market, we're witnessing more homeowners putting their properties up for sale. However, this increase is relatively modest compared to pre-COVID levels, indicating some hesitancy among homeowners to list their homes, possibly due to favorable fixed mortgage rates. Demand, measured by the number of new pending sales, has also seen a 4% increase in the past couple of weeks. The current demand level stands at 1,538 pending sales. This uptick is indicative of heightened buyer activity with the onset of the spring market. However, it's essential to note that demand levels are still lower compared to pre-COVID times, suggesting a more tempered market environment. The luxury market. The luxury market, comprising homes above $2 million, has witnessed a slight slowdown recently. While inventory has increased by 8%, demand has dipped by 7%, leading to a rise in expected market time for luxury properties. Despite this slowdown, the luxury market remains relatively robust, buoyed by strength in the equity markets. Now, what are the impacts on sellers and buyers? Luxury home sellers may need to exercise patience as properties may take longer to sell, necessitating strategic pricing and marketing tactics. For luxury home buyers, this could present opportunities for negotiation and potentially favorable deals. And now, I'm going to pass it to Chris to go over some key economic insights that impact our housing market.
Thanks, Brooks. Supply has been outpacing demand slightly, causing the expected market time in Orange County to rise recently, but are still at or below last year's market times in most price ranges. This chart breaks down the market time by price range based on the previous month's activity. It's worth noting we're currently in that traditional 4-month window when our market sees its most activity. Interest rates have certainly had an impact, and it's noticeable when mortgage rates rise above 7%. This chart provides some great insight for those of you that are not breaking down the data and reviewing it weekly, like us. I think the percentage of inventory and demand provides some great insight for buyers and sellers whether you're already in the market or thinking about making a move. If you find value in our market reports, hit subscribe so that you don't miss our monthly market updates. Now, lately, there has been more talk about the increased foreclosure activity. This is to be expected when coming off of record low foreclosure filings due to the government's COVID-19 forbearance program, moratoriums, and other mortgage relief options for homeowners. As pandemic legislation and programs expired, foreclosure filings as a percentage appeared as if they were skyrocketing, unless you compared them to pre-pandemic numbers, which would have been more appropriate. The sad truth is those numbers had nowhere to go but up. And keep in mind, foreclosures will always be a component of the market. Let's dive into some national numbers to gain a little bit more perspective on the U.S. foreclosure activity. CoreLogic reported earlier this year that less than 1% of U.S. homeowners with a mortgage were 90 days or more late on payments in October. And the nation's overall mortgage delinquency rate was just 2.8%, unchanged on both a yearly and monthly basis. In January, Adam Data Solutions in Irvine reported that although U.S. foreclosure activity has increased from 2022, it's still below pre-pandemic numbers. This is important because a lot of the percentage increases that have been thrown around recklessly on social media to entice clicks and drive a doom and gloom narrative that has been pushed for several years. They don't use pre-pandemic numbers to calculate the percentage of increased foreclosure activity because, well, it tells a much different story. You can see here in this historical chart, which puts things more into perspective regarding U.S. foreclosure filings compared to the percentage of U.S. housing units. You see the spike in foreclosure filings during the 2007 Great Recession. We always like to point out that the poor lending standards and adjustable teaser rates, which led to that market downturn in 2007, are nothing like the stringent lending standards that have been employed for well over a decade. Not to mention today's record high homeowners' equity, secured by historically low fixed rate mortgages. This is a huge number of housing units with mortgage rates between 3 and 5%. You would probably be surprised at the number of them that would rent for above their mortgage payment. On March 11, Adam Data Solutions reported 32,938 U.S. properties carried foreclosure filings in February, which was an 8% increase from 1 year ago. Lenders began the foreclosure process on 22,575 U.S. properties in February 2024, up 4% from the last month and up 11% from a year ago. Among those major metropolitan statistical areas with a population of at least 200,000 and those with the greatest number of foreclosure starts in February 2024 include New York, 1,367 foreclosure starts, Houston, Texas, 998 foreclosure starts, Los Angeles, California, 808 foreclosure starts, Chicago, Illinois, 792 foreclosure starts, and Miami, Florida, at 777 foreclosure starts. Now, it's important to point out that Los Angeles, for statistical area reporting purposes, includes the counties of Los Angeles, Ventura, San Bernardino, Riverside, and Orange. So that's several million housing units based on census data. Understand, not all foreclosure filings complete the foreclosure process and become REOs, which is what lender-owned properties are more commonly referred to in the industry. So let's look at the U.S. REO numbers. Foreclosure completion numbers decreased annually in 28 states. Lenders repossessed 3,397 U.S. properties through completed foreclosures, REOs, in February 2024, down 14% from the previous month and 11% from a year earlier. The Orange County market has not seen any dramatic impact from foreclosed properties hitting the market. They would sell quickly and possibly with multiple offers, given the low inventory. To put it even more into perspective, as of March 14th, there were 5 REO foreclosure properties on the multiple listing service in Orange County. As always, we'll continue to monitor the data and break it down to keep you better informed.
And there you have it, folks, a comprehensive overview of Orange County's real estate market trends for March of 2024. As always, it's crucial to keep a close eye on these numbers and trends to make informed decisions in this ever-evolving market. The current statistics paint a picture of a market in flux with both opportunities and challenges for buyers and sellers alike. If you found this video helpful, don't forget to hit like, share, and subscribe for more insights. And until next time, take care and happy house hunting.